Michael, that's an excellent question. Thank you. Making more money has to do actually with two different things. One is making the money, bringing the dollars in, and the flip side of it, of course, is preventing the dollars from going out. In an insurance world, that's called claims. So let's just take an example. Let's just suppose that you are someone who just simply wants to go out and buy the everyday average automobile insurance policy to protect yourself and your family from the harms and dangers that can occur when you're driving your car down the road. You go to your insurance agent, and your insurance agent says, okay, I'm going to give you this great policy. You're going to have full coverage. Well, that's the first warning sign, folks, because there is no such thing as full coverage. That is code in the insurance world for we're going to sell you the smallest, cheapest, most horrible, ridiculous insurance policy that the state allows us to get away with selling you. Full coverage is a ridiculous thing because the more premium dollars you pay, the more coverage you're going to have, and there is no cap. I'm a real nervous guy. I have a real big insurance policy. So here's typically what happens. Let's take the state of Virginia just as an example. The law in Virginia requires that you have something called $25,000 worth of liability coverage. And I am not a salesperson for insurance products, but I'm just going to take a stab because I've seen these a lot. The average insurance company might sell that for $183 for a 6-month period. Okay, so you now have $25,000. If you cause an auto accident, you hit somebody, say stopped at a red light, and they have an injury, you are going to be responsible either by settlement, or if they sue you eventually, you could be responsible for paying for their medical bills, for paying for the time that they missed from their job, the dollars they lost because they couldn't work because they were injured, and as well for what's called the disruption of their life, their pain, their suffering, their inconvenience, their aggravation, all of those sorts of things. Your insurance policy is going to cover all of that up to $25,000. But let's suppose that the individual that you hurt was pretty seriously injured. Let's suppose that they hit their knee on the underside of the dash when you banged into their car and they need knee surgery. With today's medical care costs and facility charges and anesthesia and surgeon's fees, by the time you get finished, that claim is worth a lot more than $25,000. So you expect your insurance company is going to pay all of it, right? Well, no. That's a contract. You paid them a premium of $180 some in my example, and they gave you coverage up to $25,000. That's all there is. So if it's 30 or 35 or 40 or 50 or 70, whatever the judgment against you, whatever the value of the claim, you're on the hook for that all by yourself. Now you say payments, you have your car taken care of, that's collision and comprehensive coverages. We're even going to throw in towing, so rental car, so everything that is there you've got, my friend, and that's actually not true. Now here's why. It's true you have them, but it's not good coverage, and the agents are telling you it's full coverage. It's nowhere near full. There is no full. But here's why they do this, because again, I offered at the beginning of this discussion that making money is a two-part process. It's bringing the dollars in and making sure they don't go out. The insurance company, if they're going to sell you a better liability policy, say $100,000, which would be appropriate and adequate in most cases to cover you if you cause a collision, well, the insurance premium might be $200 or $205. It's 4 times the coverage, but only another $15 or $20 or $25 more in premiums. So if you're the business person, would you rather collect $25 more in premium, or have yourself exposed for $75,000 more, or would you rather not take in that extra $25, but your exposure is capped at $25,000? Well, of course, the answer is you'd rather have the small premium, the smaller premium, and the limited exposure, because enough times during the course of the day, people get into collisions, and a goodly number of them often are valued more than the minimum limits that the state in which you're in requires you to have. So the insurance people are making decisions to not tell you about the cost of bigger policies, bigger coverages, better coverages, because that exposes them to having to pay more.